So what is growth investing? And I'll explain growth investing, but first you can read the definition of what a typical growth investing means. So growth investing is basically investing in the fastest growing stocks. Actually, this style of investing focuses on investing in stocks which are growing really fast, like rapidly fast. And the persons or the investors who are interested in this philosophy are called growth investors. And they don't focus much on the price that they are paying, although they still don't pay too high a price for a high growth stock, because paying too much means that they will have to wait for a long time to get their capital back, and let alone the return that they are expecting from the stock. So they are ready to pay a higher price because they know that in order to get the quality, they can pay a bit more. And it basically means that high growth stocks are usually expensive. Unlike value stocks, they are not found cheap in the market. And the reason is, if a company is growing really fast, then everybody wants to get a share of that company. And so the price is high. But investors investing in these type of stocks know that the price paid to buy a stock today is not as high as the high growth of the stock, which is going to compensate for that stock. And one more characteristic of high growing companies is that they do not pay dividends, because of the fact that they are in their initial stages of growth, which means that a lot of growth potential is still untapped in the market. And that's why whatever the company earns, it invests all of the profits in the company and don't pay shareholders. And actually they are fine with the company not paying dividends. And the reason behind this is that the company has a lot of growth potential. So rather than getting paid and hindering the growth process, the company, by investing in itself, takes advantage of growth, which helps in increasing profits. And this is because they know that the company has a lot of growth potential left. So rather than getting paid and hindering the growth process, the company, by investing in itself, takes advantage of growth, which helps in increasing profits, which ultimately increases the share price. So basically, growth investors are looking for capital appreciation rather than the dividend income. And because they know the fact that the company is in its growing stage, so why not invest all of their profits in the company? And because the share price is increasing, they are patient enough to wait for the company to grow high enough, and then they enjoy dividend income. And one more thing to remember is that growth stocks are expensive, or they command a higher valuation because they are growing rapidly. But if the growth falls short or doesn't meet according to as the market is expecting, and even for only one quarter, that means for every other quarter the company is meeting the expectations of the market, then the stock is going accordingly. But if the stock doesn't meet the expectations even only for the one quarter, then that can prove to be a real problem, and that can lead the stock price crashing. And there have been several incidents where a high growing stock which had a higher valuation crashed when the company released their financial statements, where they were not growing according to the market expectations. So these stocks rise rapidly, and they have the potential to rise 100, 200, 300, or maybe even more than that because of their high growth nature. But they have huge risk, and if they fall short of anything less than what they are expected to grow at, then that's a serious problem for these stocks. And in a nutshell, that is what we call a growth stock. And right now, that's it for this tutorial, but in the next tutorial I will be telling you how to find a growth stock. So look out for that tutorial also.